Today's episode is brought to you by Stream by Mosaic, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free 2-week trial on their website at www.streamrg.com. That's STREAMRG.com using the promo code MicroCap. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And you're listening to episode 205. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rcraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the MicroCap message. Special thank you to our sponsors for today's episode, Stream by Mosaic, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free 2-week trial on their website at www.streamrg.com. That's STREAMRG.com using the promo code MicroCap. And Quarter, whose mission is to change the way people look at investor relations and create a completely new bridge between companies and stakeholders. Visit your app store of choice to try it out, and that's Quarter, QUARTR. Thank you to everyone who participated in the SNN Network Canada virtual event. We had a great week showcasing some of the best of the undiscovered companies and insights from the Canadian microcap community. All the keynotes and panels are currently available on the SNN Network YouTube channel, and the company presentations are available for replay on canada.snn.network. This will be our last virtual event until the second half of 2022 because we are 100% focused on seeing all of you at our first in-person event in nearly 3 years. The Planet MicroCap Showcase is back in Las Vegas on May 3rd through the 5th, 2022 at Bally's Hotel and Casino. It's time to see each other. It's time to network in person. Let's make it all happen in the entertainment capital of the world. For more information, please go to www.planetmicrocapshowcase.com. See you in Vegas. For episode 205 of the Planet MicroCap Podcast, I spoke with Richard Sosa, host of the Riches in the Niches podcast. I've been following Richard for a while now and wanted to get to know the man beyond his famous food takes. He is a passionate investor, and it shows when we dive deep into what Richard calls Sosa's 5 forces. I really enjoyed our conversation about his investing style as we turn the mic around on a fellow colleague in the field. Thank you again for tuning in to episode 205 of the Planet MicroCap Podcast, and please enjoy my conversation with Richard Sosa. This episode is brought to you by Stream by Mosaic. You can find them at www.streamrg.com. That's STREAMRG.com. Stream is an expert interview transcript library that is starting to become an integral part to investors' research process. They have a number of interviews on a wide variety of companies, including TMT, consumers, industrials, real estate, and more. Stream provides over 300 expert interviews per week, and 70% of their experts are found exclusively on Stream. Stream was built by Mosaic, and unlike any other transcript libraries, Stream integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Stream's community of experts and thought leaders partner with Stream to build their professional brands and expand their industry influence. Right now, there are approximately 8,500 plus call transcripts available. For more information, please visit www.streamrg.com. Welcome back, everybody, to the Planet MicroCap Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And joining me today is someone that I got to tell you, I really just appreciate following him. He's got a new podcast that it's not necessarily new anymore. I think we're at like 30 plus episodes at this point. And I'm really appreciative for him taking the time today to be on the pod. So again, I say this every time. It's a long time overdue, but joining me today is Richard Sosa. He is the host of Riches in the Niches podcast. With that, Richard, thank you for joining me today. How you doing, man?
I'm doing great. Thank you very much for having me. It's, believe it or not, I'm telling everyone this is the first time Bobby and I have spoken. So, thank you for the podcast mention. I'll be honest with you, one of the main reasons I started the podcast was to be able to have a reason to reach out to people. And, it's in that sense, it's been really cool because you get to talk to smart investors and, most of them, everyone gets back to you, they'll say, yeah, like I appreciate it. It's just nice. And a lot of times you want to have these conversations anyway, but because you have podcasts, it just makes it easier. Right. And then you record it, you got transcript, you remember it. It's, you never know what you can learn from it. And, I appreciate that. And I definitely appreciate you reaching out.
Oh, absolutely. I mean, look, we have very similar concepts. When I started this back in 2015, I always thought I was a terrible investor, but back then, very much so. And I wanted to take people on that journey with me, and really share a lot of knowledge because Riches in the Niches, very similar in concept. I'm sure we're talking Planet MicroCap. We've had similar overlapping guests, there's not a lot of microcap type content out there. I had friends all the time say, "Oh, you're a microcap stocks." Like, what is a microcap? It's like, was that like penny stocks? It's like, no, it's not penny stock. It's a microcap. All right. But I digress. But look, as you said, this is our first time talking together. And I really appreciate you coming on here, but let's start this out. I'd love to know where your passion for investing and finance came from. So take us to baby Sosa all the way through today.
I love that. So, my background is pretty boring. I grew up in Northern Virginia, Washington Redskins fan or Washington football team fan is what we call them now. Loved where I grew up. Never invested as a child, right? And it wasn't my thing. Went to school in the West Coast, Arizona State. And my first job out of college was at an investment bank. And I was what they call an institutional equity salesperson. This was, 2004, 2005. And that's what really introduced me to the world of finance. I mean, so take it back then, we had just finished the tech boom, right? I wasn't invested. I just knew about it. People talked about stocks, my friends would make money. It wasn't for me, right? Then in my first job, this is 2004, at a company called FBR. I got the job through a mutual contact. And at the time we had sponsored the Phoenix Open. So it was kind of, I met them in Arizona and became an institutional salesperson, a junior institutional salesperson. So it was really doing all the grunt work, right? Getting coffee, calling on hedge funds, usually the junior analysts, calling them on the stocks we covered. And FBR at the time, which is now part of B. Riley, but at the time we were really known as, we raised money for mortgage REITs. We did a lot of that quirky stuff. Like we raised money for really the deals no one else wanted to do. And it was an amazing place to have a first job because, the salesmen really had to understand these products because they were very niche. Like, at the time we were doing, it sounds, in hindsight crazy that we were raising equity capital for mortgage companies that were levered, 10, 20 times equity and originating mortgages and selling them to banks. Like in hindsight, that sounds like, oh, how'd that work? But back then it was working. There was a big market, a big mortgage market. And to sell these products to institutional investors it took, a lot. You really had to understand these companies. You understand the math behind the leverage, the math behind the earnings power and the payouts these companies would make if the, housing market continued, Back then, the narrative was the housing market never goes down. That was our pitch. We had all this data. The housing market never goes down. And it really hadn't. We had gobs and gobs of data. We send to people. And so there was a boom and there was a need to originate subprime mortgage loans. And, FBR really brought a lot of these companies public. And, it was an exciting place to work because you learned a lot. We also covered regular companies too. We really focused on small and mid-cap companies. I mean, that was our thing. Mostly small cap, like all the mortgage companies we raised money for. Of course, there were $200 or $300 million market cap. So you really got to, what was more exciting than doing the research was meeting the people buying these stocks, right? So as a young person, you were, in a meeting with Bill Miller, Mara Gabelli, these people, and selling them, right? So you really and I don't talk enough about this in my podcast, but as an equity salesman, I mean, we had to be friends with the research people. We had like 50 analysts that covered consumer, energy, financial services, a little bit of everything. But it was both value and growth, right? Mm-hmm. So our clients would be kind of a hodgepodge of stuff, right? So I at the time covered the West Coast. I was on a team that covered LA and San Diego. Like our biggest account was the Capital Group, right? The America funds. And we wouldn't meet with as many growth investors because it wasn't really our thing. But we didn't meet with them. So I was always fascinated about how everything's in a bucket, right? I definitely want to talk about that in this podcast because I feel people don't think enough about how institutional capital and flows work. And I think that's what's led me to my investment philosophy is like I learned, I think at a pretty young age, that everything goes into a bucket, right? A lot of stuff goes into a bucket. And growing up that way, I just learned that you either were part of the bucket or outside of that bucket. And, over 15 years, I learned that for me, investing in companies that weren't in a bucket, that were going into a bucket, like those were for me the best opportunities.
Interesting. I'd like to take a quick second to tell you about this episode's sponsor, Quarter. With Quarter, you get frictionless access to conference calls, investor presentations, transcripts, and earnings reports from markets all around the world, straight from your pocket for no cost. Quarter's mission is to change the way people look at investor relations and create a completely new bridge between companies and stakeholders. The first step on this journey is to let you, the user, interact with the company's content while you're listening. Visit your app store of choice and try it out today by searching for Quarter. And that's Quartr. Now back to the show. So tell me a little, let's go down that rabbit hole for, talking about institutional flows, because in microcaps, as you're very well aware, right? Most of us are looking for those opportunities before they get picked up by institutions. So having that experience in mind, what led you to looking, a little bit more downstream, even, past small cap land into microcap land? Was it that realization?
That's an interesting question. It really came about when I started realizing a lot of these investors, like they all invested in microcaps. Like it's fascinating, but they all
isn't it so fun? Sorry, I don't mean to cut you off there, but I bring on Jim O'Shaughnessy and something like he envies every microcap investor because they can, and he can, he loves this space. So I'm sorry, it's just a point because I hear that all the time too.
Yeah, and it is. I mean, there's a variety of reasons for that. I mean, the biggest reason I think is that the microcaps don't overlap, right? There's no overlap with the flows. Like flows, companies that most people are aware of that are owned by a lot of people and that trade, that have volume, that a hedge fund can own. And people don't understand hedge funds cannot own everything. They can only own really popular stocks that trade, that you can borrow off of or short, and that's most of the market. And those stocks, I mean, look, I'm sure you've talked about this in your podcast a lot. Like, look, I don't want to compete with 1,000 and 2,000 people because you know what? Investing is hard, right? I mean, there's people that know these companies inside and out. Like these hedge fund guys, like they know what's going on. They knows what drives these companies. They've done the research. And a lot of times, like I'm a big believer in research where I love podcasts, I love people sharing, but there's so much you can learn about a business. And then with bigger companies, it's harder, right? Because, the fundamentals are well known and you're really, I feel, just betting on the trend, right? And you're betting on flows, which is, people are good at it, right? They're really good at it. But, in the microcap land, you don't have to bet on flows because you probably won't get them. I mean, look, everyone talks about this, like ultimately, if you get the flows in the microcap eventually, like that's where you can, that's where you get like the 1,000 baggers, right? Like the companies know, that's what everyone looks for, I think, in microcap land, the holy grail. Find that little company. and maybe I can get into this now because I think what made me catch the microcap bug was my first big investment where I put a material amount of my wealth into it. And there's a company called, I'm sure you've mentioned in your podcast, it's still around, a company called Mitech Systems, MITK. I don't own it now. But 10 years ago, I was working at a smaller firm called Global Hunter, and it was mostly focused on energy, but we did some, microcap stuff, and we did a lot of non-deal roadshows. That was our thing. That was a great way to get paid. And that time, it still is for institutional brokerages, but we'd set up a lot of non-deal roadshows for microcaps, and Mitech was super cool. And it kind of got me into that, mindset where if you buy a company that's cheap that nobody cares about, and there's like something interesting there, that can take off, you can make a lot of money, and the risk reward can be positive if nobody's really looking at it or nobody cares. And look, it was different. That 2010, this was right after the financial crisis, so there was a lot of these opportunities, right? Because even well-known companies, like no one was buying stuff, right? I mean, you hear about these big people buying stuff, but it was in 2010, people were still scared, right?
Yeah.
No one was going YOLO and hodling, right? No one was doing that. It was
Richard, hold on, I gotta ask you, we must have crossed paths at a conference. If you were a Global Hunter, I remember going to the Global Hunter conference. I think it was, you did a San Francisco show.
Probably.
Yeah, we definitely have crossed paths.
It was a good place. We did a lot of road shows. That's where I kind of, at FBR, I didn't trade much. I just, because you also have to learn about companies, right? And
of course.
And it was kind of frowned upon to trade. Like, they didn't like it. And we had a head of sales that was really strict about that stuff. It's like, why are you buying these stocks? Like, it's because we can't buy the stocks we cover, right? Which was always, of course, the biggest. I never understood. You couldn't sell things you covered, right? You couldn't really own things you covered, right? So the stocks you really cared about, you couldn't pitch people on, which absolutely makes no sense.
Well, for those who don't know, I mean, why is that the case?
It's just really just a simple compliance reason. It's like, people think, well, if you think about it, you're talking a capital group or something like that. I mean, and I'm digressing, going back to where I was, but the thing is, when you call these big accounts, you really know what makes them tick, right? And that was, I think, what I loved about being a broker is you really understand, you get to meet these people, you understand they don't rely on the sell side, but they do look for ideas. They don't care where the idea comes from. They're going to do their work, but sometimes you can present them with something that they haven't seen it in the way you're presenting it, right? And they're going to do the work, but it takes that and to do that sometimes. But you really learn that these buckets look at stocks differently, and I love that about where I was, to be able to see how they looked at things, and what made them. I mean, salespeople could convince these institutions to buy stocks. You really could. I mean, I think at the end of the day, that's why it's frowned upon, because if you own this Acorn Energy, 40 million shares, trades 20,000 shares a day, and you got Capital Group to take 20% position, they won't tell you, but right? Especially if they're trading it through you. And that's the thing, if they're trading it through you, you're not supposed to buy ahead of them, right? I think ultimately, so most firms don't like it. They don't like it. Every trade has to get approved, and they'll always ask, why are you buying this?
Right. By the way, real quick, Acorn, are you a shareholder?
Yes, I am a shareholder.
Okay, just
It's a company I do like it, and it reminds me a lot of this Mitech that I just mentioned, where you had a business that was cheap, and then it was really transforming into something else, and that transformation wasn't really, well known with average investors, and it did work out. So Mitech at the time, they're going back to where I was in 2010. They had they processed checks. They had a technology, a legacy technology that processed checks for banks. And it was a small, ticket item for banks, right? But it had some cash flow. It was a dying business because checks are, processing checks was something banks did less and less. But they had created and had a bunch of patents for a remote check deposit software, right? And let me tell you, back then, not being a tech guy, it's like, it was so interesting to learn about it, right? And they had licensed it, to Wells Fargo and a couple other banks and Chase. and they were having an issue, I think, with Chase or Wells Fargo at the time. And, nobody was given credit for any kind of success. And the whole call was like, look, they're going to win this case. Chase, Wells Fargo is not going to, has to use this. They have to use it. It's a product they want, right? And their technology really, all the patents for this, prohibits them from doing it without, and the contracts that they had it without my tech. So once that went through, once that essentially that lawsuit went away, the stock went from like 30 cents to $20, like that. When you put a lot of your net worth, I don't think, the high you get from putting what ended up happening, this is all, of course, 6 months, almost like a biotech, but not a biotech company, right? It went from 20 cents to 20 cents, 30, $1, $5, and then boom, a couple West Coast institutional, small microcap, small cap guys came in, and the thing went to 20. It became a small cap, and fortunately, I sold it. Unfortunately, I sold it like at 7 or 8, which is still it was a huge gain.
That's a huge
right, but it went to 20. It was hard to see it go to 20, but it did pull back, and look, 10 years later, the stock's at 17. Right, it did overshoot. But it was one of those that you look for that repeatable thing all the time.
Well, was that one just timing? I mean, like, or because I mean, it's rare. I mean, it's rare in a non-biotech that you have an outcome like that, right? Where it's that biotechy outcome. You're like, okay, I'm investing 6 months, maybe a little early, but just because I'm going to ride it till maybe they have those good positive results or whatever, and it's
that's a good question. I've looked back at this because I've since then I've looked for these type of opportunities, and a lot of times those don't work. And the way I look at stocks, like, it's changed a little bit, actually a lot of bit. And I've tried to look back at this MyTech. Was it just a one-off and luck? And I think one, it was priced way too low to begin with, and then it overshot. That's for sure. But ultimately, I think the timing, the 2010, if you invested, in that time frame, like, there was massive returns, and especially a lot of microcaps and small caps, oil and gas, like all these companies,
everything,
China stocks. You remember U.S. listed China stock? Like, there was just a lot of, nobody was investing in small caps, then people were investing in small caps, right? So I think it was really the timing, and then what I talk about sometimes is the conviction and the sizing. I mean, you put a 20%, 30% of your net worth in a company, and it goes up that much. It's meaningful, right? And I don't advise people to be concentrated like that. I think it's risky, but it's not. Also, if you've done it before, I believe it's a great way to invest. I mean, look, nobody makes money on their. People talk about like diversification and doing really well with your 30th best idea, but I don't know. I've never regretted not owning more of like a number 8 holding. Honestly, I've never. Yeah.
Because
I've always been my good holding.
So you have like 6 or 7?
Yeah. I try not to go over 10, but 6 or 7 names. And I'm sure you've talked about concentration on your show, but because I'm so concentrated, you have to run it differently than somebody that's more diversified. Like when people pitch Bitcoin and cryptocurrency, I think there's a lot of great stuff there, but it's not for me because it's a program to be concentrated. So for me to put a 20% position in a cryptocurrency, it's extremely speculative because I have to put 20% of my net worth into it. And, for those reasons, it's hard for me. Like, for me, I just can't put 1% into some things, and I'll just end up doing it 100 times. And it's just not what I do. It's what bigger investors do. But, so it does explain why I look at things a certain way. I mean, when you're so concentrated, you have to think about risk a lot more. And you have to think about your down. People do not, especially now, people do not think about their downside at all. Right.
That's a whole other rabbit hole. We're going to come back to that because I think that's a really interesting conversation to talk about some of the market frothiness and just some of the insanity that we've all seen. I mean, you talked about crypto a little bit, like we'll get there. But it ties into some of your criteria, that I wanted to speak with you about. I think one of your Twitter followers, who I will pull up in a second and give credit to, after you give your answer. But I wanted to talk about your 5 forces that you put out there in your in this memo to one of your holdings, DFIN. So love to learn a little bit more about what the Sosa's 5 forces of investing are. So let's get into it.
The way I've looked at investments has changed. Like, it has changed over the last 10 years. And I think it's, for every investor, you want to evolve, right? I mean, but it's good to look for certain things. I am a generalist. I will look at anything, but of course, I think everyone, they look for things that they have had success in the past, right? I mean, I have nothing against all industry. I do feel comfortable just with certain stories and certain industries. But I think I always have to start with management. Like, the great thing about microcaps and even small caps is, like, you can meet these people, right? And you might not be able to do a podcast with them or talk with them for an extended period of time, but there's all these avenues for to be able to meet them, even ones that are really shut down and don't do conference calls and stuff. If a shareholder calls, they will talk to you, and because of that, I feel you can learn so much from them, and you really can understand, where they are, what bucket you can put them in, right? So I think a lot of people might not be, great fundamental investors, but I think most people in general can get a good read on somebody, right? And they think a CEO is meaningless, but you can learn a lot from a CEO's incentives. So really, the most important thing I see is the management, right? And are they people that, like, you're going to put 20% of your portfolio into something, you got to be somewhat passionate about them. And they I know Buffett talks about owning businesses that, are idiot proof, right? But, I do like management teams that are either fanatical or just really predictable. And I say predictable a lot because I think you want people to be predictable, because, the worst management teams really are the ones that are unpredictable, where they just do things like, why do they do that? And I think that's when you can get really burnt, because they usually they always wanted to do it, but they didn't, tell that to you. You don't want someone lying to you, right? And so character, I think, is something, and execution and predictability. You want to know what you have, right? You have to know what you have in a CEO. And if they're good, I mean, I say that word fanatical, how can a CEO is fanatical? I think it's judge a character. You can just talk to them, see how they talk, and then talk to their employees, right? Like, people will talk. Like, I know Ben Claremont. I mean, he does a good job. He talked about on the podcast with me how much due diligence they do with employees. Like, it's so easy to contact somebody, especially now with social media and LinkedIn. Like, most of them will talk to you. I had Cheryl Beitschalder from Popeyes, and we talked a little bit about that. And she said, "Yeah, just go to Popeyes. Like, a franchisee owner will talk to you. Like, they love it. Sometimes they're a little skeptical because they're worried, but you can get a good read. And you want a good culture, and you don't need the best. You don't need a Google-like culture, but you want a good culture. You want a management team that's predictable, that is driven, right? It's really, really driven. That they own stock, but sometimes that's where I've kind of evolved. I think, like, I don't need the 30%, 40%, of the company owned by the CEO. I think it can present problems if they own too much, quite frankly. But I do like some skin in the game, because I think people forget, like, not all management teams are stock people, right? They don't look at it that way. They look at it as a source of income. They're not thinking like Warren Buffett and not paying taxes, right? That they're thinking about their family and cash flow, right? And they know usually the market is unpredictable, right? Sometimes they can't even value their own company, quite frankly. And I actually like that. I
love everything that you just said about talking to management. I mean, it's so true. I mean, look, you're also coming off. I just had a week doing our virtual event in Canada, and talking with CEOs, doing the CEO interviews, and listening to 70 presentations. And it's such valuable information. If you're going to take the time to go and actually see the presentation, take that 20 minutes to talk to the CEO. That's differential insights that maybe some others who would rather not do that might save you some money or result in a huge win, where you get a better idea of the tenor of the CEO. Like, how cocky are they, right. or how like subdued or conservative are they? You don't just get that from reading a 10K or 10Q. I mean, some can because, some are like Maj who, info arbitrage, like have been doing it 30 years and could probably tell. But even he loves talking with management teams still after doing it for 30 years. And he's one of the best in the business, so I 100% agree pretty much with almost everything.
I love it. I think it's so important. And, people, they rely on podcasts and
other pitches, which is fine,
but they don't know that they can just call them. They have the ability, and anyone that with a basic understanding of business, I think they can just get a read on someone. Like, am I going to give? Because you're essentially giving that person your money, right? Like, do I trust this person? With
People run businesses.
Yeah. You got to exactly. You got to trust it, right? That's so important to me because everything starts there, I think, right? I mean, it starts there, and you want them. Granted, you don't know them as much as you ever could, right? Mm-hmm. But I think people, you want to give your money to someone that when they say they're going to do something, they do it and they execute and they can explain it to you and that they're excited about what they're doing. So that's one. That's the most important. And that is something that's evolved over the last few years, right? When I've been able to talk to more of these people, and then a lot has evolved from the losses, right? You look back at your losers, right? And then you see the pattern of why, you get too caught up in some of the other things I'll talk about, and you ignore the primary, everyone has their subjective ways to look at people, but for me, I think I built I want to know what I have, so that's good. So the second thing I think is,
I was just gonna say we've done 15 minutes on one force.
I know. I don't want to. It was the most important, and the others are easier, right? The others are easier. So I talked about my tech. It was my tech. I would classify as I think what a lot of microcap investors look for. The biggest one, the revaluation, the narrative change, right? If at the end of the day, if you own a stock that's cheap, like there's a reason it's cheap, right? It's either too small, which, the microcaps are usually too small, right? And so the narrative change for me is like, okay, well, it'll get bigger. And once it does, and if you can predict that, institutional money coming in, like you can have a monster of a stock, right? But what I think like more is, and I've had a lot more success with it recently, and I'll talk about DFIN, which fits all these five after I finish. But it's really the narrative change, right? Because a lot of these businesses, especially when you go into small cap and mid cap, they're not like microcaps that are unknown, right? They're pretty well known. Like you gotta give, people talk about efficient markets, and you know what? I'll give Buffett credit. The markets are pretty efficient, right? When you go in small to mid cap land, and even some of the bigger, more liquid microcaps, they're pretty well known, they're pretty well known, and so you have to see why are they trading the way they are, right?
I call them the cult microcaps.
Yeah, the cult microcaps. Yeah, they're well known. So it's and they are the microcaps, individual investors can drive them, right? So I like the narrative changes. So with DFIN, you have a legacy printer that was part of R.R. Donnelley, a legacy printer that's still a printer just getting taken out, that they're known as a conglomerate, a roll-up of printing assets. And DFIN was in essence a company that was really rolled up into R.R. Donnelley really 2006 to 2011, right? So it was just recently that they had bought DFIN to really attack the capital markets industry and the printing in that industry. So when they spun out of R.R. Donnelley, really out of necessity, and the company was just falling apart, right? A lot of debt. They spun off DFIN, another company, LSC. I did magazines and textbooks. So DFIN was they're going to focus on capital markets. We're going to just throw as much debt as feasibly possible because we can't handle it. We would just put as much as we can give them, as much as they can handle, so that it doesn't go to zero. So they did that, and they took on a plan and said, we're gonna be a software company. And they said that really, a year into that spinoff in 2017, that we're going to be a software company. We have these clients that pay us, for printing prospectuses. That's the really big thing, like printing IPO docs. That was what you'd think of a legacy Donnelley business. But we have that, and we have these nice software products that we can just sell them at the same time. Right? Like, all your filing of 10Qs, 10Ks, you're no longer printing them as much, but you got to file them with the SEC. we're going to push that. That's much more, it's just better, more recurring. And, you know, we do have some money to invest in that because even though they had a lot of debt, they still had a legacy business that had a bunch of free cash flow. So they were using all that free cash flow, pumping it into the software. And go ahead, you're going to ask.
Yeah, I was going to say, like, so like on this point of narrative change, is that something that you look at as part of your idea generation? Or is that some? Okay, all right. I was just curious.
So with DFIN, you have
like in hindsight, it's easy to say like, oh, I love narrative change, and then you see the performance. But it's like it makes more sense when it's like, okay,
right. So with DFIN, you have a legacy printer that, quite frankly, is trading today, in my opinion, still as a cyclical legacy printer. A cyclical business is, you know, okay business, you know, but it's tied into the capital markets. And by the way, the capital markets are experiencing something we have not experienced since I was in college and I didn't look at stocks, right? The IPO market's never been stronger. So, you know, they've benefited clearly. And that has, I think, taken the stock from, you know, 10 to 40. I think that has really moved the stock. I mean, look, the earnings, you go from, you know, $120 million of EBITDA to 300 on essentially the same sales, right? And just the margins exploded. Well, not the same sales. They sold some businesses. So yeah, you can say that they grew. But, you know, for me, the real money, and people say, oh, it went to 40. Like you went to 10 to 40. Great job, Sosa. I was like, well, no, because there was a lot of things happening in that time that you couldn't have predict, right? Like there was a lot of changes. Like they print a lot less now. And then their software, which was only like 15% of the business of sales in 2016. I mean, it's approaching 30. And every employee I've spoken to there, they'll say 44 and 44, 44 and 24, 44% software in 2024. Like that's all over the company. So, you know, if they're doing 50%, 60% of sales in software, it's going to be re-rated. I don't care where we are with growth stocks and software stocks. Like in 3 or 4 years, if they can get half of their business in software that's growing 20 to 30% versus a legacy business that's really not growing and very cyclical, like the software business is not cyclical. Some of the growth might be, but at the end of the day, it's a recurring payment. Like you got to file, right? The only way you're going to lose that business is that company gets taken out or goes bankrupt. That's people don't just change their providers of this stuff. So if they're known as a growth company, I mean, the multiple change and re-rate is incredible, right? Like it's how, you know, $40, you throw a fraction of a Broadridge or Workiva multiple, which are comparable companies and some of the software subsidiaries, and Broadridge is the most comparable company as a, you know, a holdco, and you have like a $200 stock, right? Like it's, you know, it's that's what I look for. You know, I don't look for companies that are, you know, okay, it's worth 20% more. That's not why I invest in a company, right? Like I see their vision, I see what they're trying to do, and more importantly, I see that no one else cares because they only see it's a legacy print business, right? Cyclical. And then you have to take a leap of faith and say like, no, everything that they're doing, it's working, and they're not getting any credit for it. And I understand why they're not getting credit for it, but eventually if they keep doing it, you know, you can have this massive re-rating. And that's what I say about narrative change in the sense of, you know, we talk about Mike Mitchell, he says ignore narrative, but I think narrative is everything. It drives stocks, right? If you're a, you know, a boring legacy printer versus an exciting 30% growth software company, like 30% growing software companies, like we don't even have to talk about multiples because they're extraordinary. Are they too high? Maybe, but you just get half of that, and you know, defense much higher. So I like that, and an investment. I like that change.
You know, going on that point from Mike, I mean, he's right and probably off in certain respects, but like you might want to pay attention to it if, you know, you're seeing this thing just absolutely explode or go down. Then you're like, okay, what the heck's going on here? You know, then
I think that's what the handle means, right? You would just stick to the fundamentals, right?
Right.
And not
of course.
What people see and the hype, right? But the great thing is with a lot of the stocks that you talk about, there's no hype, right? I like no hype. You know, with narrative changes and the valuation re-rate, like I say to people, look, as a great investor, you have to be good fundamentally, but you also have to be pretty good predicting trends, right? Most people are one or the other. The great ones are both, right? And if you can predict both, you're gonna do well. And you know, with fundamentals and multiples, like, you know, I don't mind paying high multiples, but usually high multiples mean that it's a pretty well-known company. That's what it translates that way. It just works that way, right? If companies got more love, it's better known, and if it's not known, then that's usually when it's cheaper. When you start with a low base, it's better. So I do that. I'm not strict. I used to be more strict on it, but I think value investors can get hurt, right? Like they can get hurt just constantly looking at low multiple stocks and then selling them, right? They all sell them too early, which drives me nuts. Like with DFIN, every value investor, a lot of them bought it, like all the screens. But when the world came to an end last year with COVID, it was priced for bankruptcy on a liquidation, right? Fidelity, PM left, liquidated like that. And all the screens picked it up and they saw the cash flow and the debt and this is not going to zero. That's why I took such a big position, quite frankly, last year, because I knew I'd done the work for 3 years, but I'd never really owned it. I said, this company's not going to zero. There's no way. And its price is a zero. And then so a lot of value investors came in like 4 or 5 and they sold at 12, right? And they're missing the whole reason why I bought it in the first place. It was like all these things happening that I think now we're seeing. So next one is the recurring cash flow. Like Maj talks about this. I know everyone wants recurring cash flow. You want to be able to predict cash in some shape or form, right? That's important. Like, business is hard, right? And having unpredictable cash flows.
Wait, you don't like pre-revenue?
You don't
know how to predict pre-revenue moonshots?
I don't.
I mean, come on.
I don't. I like to be able to. No one can predict it, right? But I like to be able to, take a haircut to something and say, like, with defense, sure, like they're going to do $220 million of free cash flow. They're not going to probably do that, for years. And they might, but I do like to take a haircut on what's worst case scenario. And it's easy to go back and say what's worst case scenario, and I like that. I mean, they have a lot of recurring business, and people have to file documents unless everybody goes bankrupt. Oh, by the way, they make a lot of money in bankruptcies, right? Like they make a lot of money when. They make less money when things slow down. Like that's what you don't want. You don't want low activity, but that just never happens. With the capital markets, IPOs stop, M&As will slow down, but there's always something, right? And there's not something. Probably nobody's making money, quite frankly. No stock's working. So everyone, that's an easy one. And then the capital allocation, like this one's what a lot of people talk about, and I think also I've evolved with that, right? Like I think how managers dictate their flows, their capital flows, how they buy, how they think about stock buybacks, right? And how they think about investing for growth, super important, right? That's something you can look back, and that kind of goes back to a predictable management team. Like you trust that they'll do things, and going back, tying in with DFIN, and so right before COVID, they actually, the worst time, but they had since I'd followed the stock in 2017, 2019, since they were new, the CEO couldn't present. They were terrible at presenting. The numbers were super volatile. They missed guidance every quarter. And you understand, I mean, and I learned why, but there was also things that they couldn't control, right? And then finally, I think when they figured it all out, February 2020, I saw the release. Everything they said was amazing. And then COVID, it's like, so that's what gave me so much. They had their best quarter. Nobody cared. Actually, nobody cared because it was not time to care, right? Who cares, right? Who cared? COVID, everyone's dying. Everyone's going end of the world, right? And then I saw in their first quarter release that when this was what got me so excited and tying the cap, they went out when the world was ending, in March and April, they bought back a ton of debt, at 85 cents in the dollar, and they bought back stock, right? Who goes back and uses their revolver to buy? Well, they had high debt, right? They had 8.5% coupon debt. They went out and bought it at a huge discount because they had money. And for me, that was just to do that kind of stuff. Management teams don't do that, especially a company like DFIN, right? That nobody really knows, they're skeptical of, and to do that kind of stuff is that they take care. They cared and they had enough conviction. That's conviction in their business to do that. And that's what I like to see, the predictable capital allocation. And I want to see, and then the last one really ties into capital allocation. I like some of these big guys, you John Malone. You know what? When all somebody's doing is buying back, if a pitch revolves around stock buybacks, I would probably pass. And I've just always gotten not burnt, but if someone buys back all the time, that's the whole story. It just means that there's nothing more interesting to invest in. And I don't know. Like I'm a capitalist at heart. Like I think there's always something, and if there's not, that's okay, and the stock will do fine. But for me, the asymmetry is not there anymore. If it's just buybacks, right? Just buyback, and I might keep some on my watch list when the world ends. They're good names to just buy, right? Because they're going to be fine. But I need to see some sales growth and some growth, right? And then back to defense, people think, oh, well, it's not growing. They predict 1% to 2% sales growth. Well, through my research, I feel that they're not, there's more growth there. And there's more growth there they're leading on to. And the software, which anybody cares about growth there, I think they're just lowballing it. I think they don't care what anybody thinks. Like, they have 3 value investors that cover them, I think, because they wanted to be involved in the refinance that they weren't. And I don't think they're going to cover. I just think there's just no communication between them and the street anymore, and that they want the growth analysts, but the growth analysts aren't going to cover them. I mean, they're not there yet. They're not a growing company. They might have parts of their business that are growing a lot, but you don't get growth coverage for that, right? So that's kind of the way I look at stocks. Those are the 5 highlights, right? Like the big ones. I mean, obviously there's little things, but I think it has to meet all 5, right? They have to meet them all, and if they don't, it's just not really for me, right? Like it's just, I haven't found success in it. Like, and then these 5 ways I look at stocks, like that's just the way I look at things. I've had success. You can make a lot of money totally different ways. Like we've talked about crypto, we've talked about pre-rent. You can make money, all that stuff, but you have to know it. It has to be your game. Like I mentioned this the other day when growth was selling off. Like, don't just go buy growth stocks. You need to know those stocks. Like, growth investors, people, us value people will kind of bag on growth investors, but you know what? There's some great growth investors, and most of the growth investors are garbage, or are not good, but there's some really good ones that understand the business and they know what they own. Right?
No, you're 100% right. Like, I always have to be very careful on here because look, there's a good amount of microcap investors that are just mostly day traders, right? And I've been wanting to have more day traders on to really talk about it a little bit more, because I need to change my mindset about that, because I'm like you, where, I mean, look, I got all the books here, right? I mean, Buffettite, that idea of just you're buying businesses, you're looking at companies, but you're right. At the end of the day, whatever works best for you and you're making money, who are we to judge?
Like, yeah, exactly. As long as there's a process, right? Because you can make money in all those different. I mean, we talk about Soros, right? The biggest, like, the speculator, right? Like, he doesn't even say it. I think there's more than just speculation on his part, but
sure,
there's nothing wrong with it. But you don't change styles all of a sudden. I always tell people that, like, don't, they'll get you in trouble.
So I want to go back to one of the forces. I want to go back to narrative change, because this is really interesting to me, especially when it comes to idea generation. How do you screen for it? I mean, like, that's the thing. That's why you just have to come across it.
No, I think that's why, like, look, I've seen some people talk about, like, how, like, ideas theirs or whatever. It's like, no, you know what? For me, it's like, this is why you have to have a network. A DFIN, my buddy called me, and he was like a value investor. Of course, it sold like at $18. Like, he called me so passionate about this business, and I was like, what? And his pitch was that they're going to get sold. They spun off of R. Donnelley to get sold. And that was, I mean, I've done the work. That was the intention, right? They kind of built it up that way. Like, with spinoffs, they're always, something's always spun off for a reason. It probably was the reason that time, right? But he's the one that gave him that idea. Like, you can't, special situations, unfortunately you can't screen for. That's why they're special, right? Because if you screen DFIN, it'll screen. It'll screen. Well, one, there's not a ton of information. I mean, there is, but it's been, you got 10 years information, which is not a lot, right? Which is a combination of companies. But if you screen it, it's going to just screen as a value stock that's cyclical, right? And value investors won't touch it because they see. It's trading at 9 times earnings, which, when I talk about DFIN, that sounds incredibly cheap. But if you look at cyclical businesses that have no sales growth, right? And that's not that cheap, right? Maybe you give it 12 multiple. Okay, well, 9 to 12 is not a lot, not a big difference, right? It'll be owned by the ETFs and stuff like that. But that's why you have these. And people think, like, everyone finds these things. They don't. Like, why would you look at DFIN, right? You might have looked at it. The people that, and this is why I explain to people, like, which I get fascinated by how the flows change, right? Like, the value investors all owned it, and they all sold it. And we talked about JPO. I saw JPO, Shannon, all the quant funds, they all owned it, but they long gone, right? As soon as it hit the mark, right? I mean, as soon as it went from like 8 to 20, it was out. It was gone. It was easy game. It was easy. That screened easy, right? But then you in this no man's land, and I mentioned, I think Dennis Hong, like he posted a lot of good stuff, right? He posted something on how a lot of times like the returns you don't see for 5 years. And that's like textbook. Well, I think why, like a lot of these things, like if you have changes, if you're investing in like a narrative change or doing something different, it takes time. And people think, oh, well, Netflix will just do that. Or they'll just do that. No, businesses don't work that way. A business can't just do something. Apple just can't make a Peloton bike. Like even Apple, like you think it is easy, but I've learned it is not. There's so many things that you don't just, like, that's why I'm actually fascinated by Twitter. That you just like throw like, a spaces thing out of nowhere. Like they just do random products. But for the most part, companies don't just randomly launch products and launch businesses, right? It's just, you have shareholders involved. You have so many things involved. So when you see a company do it, when they don't have to, right? That's when it gets me really excited. Like, why is like a DFIN? They didn't have to do this, but they made a decision to get smaller, right? And invest in something where they didn't really know the outcome. They won't. I mean, they had a good idea that it would grow, but they were taking money away from buybacks. They paid down all that high cost debt. So that's great. But, now this is, for me, the inflection point. It's like, well, they don't have any more debt to pay off. They have none. What are they going to do with $200 million in free cash flow in a $1.5 billion company? What are they going to do with it? Right? I don't think they're going to just buy back stock, right? Because that's not exciting to me. They're going to buy back stock, every quarter. And then I think they're going to invest more than what, all their long-term plans guide them for, because, the actual cyclical part of the business is so strong that they have just all this money. And then they finally have something that they can invest in, right? And, that takes time, that takes time. And, I've talked about this narrative change, like with other people, and I've heard of circumstances. I probably should have written them down. Like I've seen, like I heard about one that I can't tell you the company, but they were, I don't remember the ticker. Like they were doing like, real estate, just regular real estate. And they moved into like towers, right? Like just tower real estate, like a narrative change from like traditional to towers, right? They just moved the money into towers,
right?
Like total narrative change. For still a real estate company, but they just went 360, but they had to make an effort. And that's not easy. Everything has to be approved by a board, right? So you make a change like that. It's not only not easy, but it does take time, right? And so I go back to Dennis's post. It's like sometimes things, when you have a plan, you invest for growth, like you just don't get immediate pay. Everyone wants immediate payback, but things take time. Like DFIN has worked well the last year, but it's worked because of investment with two reasons. It worked because of, one, the capital markets have done really well, but two, like there are investments that they made 5 years ago, right? Like they talk about how when during COVID, like they helped a company be the first virtual IPO. As you know, with roadshows and stuff, like, IPOs are done in person, right? And they were actually the first one out of necessity, that because of the investments they had made to do everything remote, from the bell, ringing the bell, everything. They helped do that. So it does take time, and it's not, a lot of them I think do fail. And I'll tell you this, the ones that fail, in my opinion, are the ones that are hyped more, right? And this is not one of my 5 forces, but I do tend to avoid, and it's the contrarian in me, but I do tend to avoid the crowded names. And the over promotional CEOs, right? Those are things that, and I understand.
I was just going to go there with you. Is talk to you about your first force a little bit more in management. I talk about that a lot on here, but everybody has a different take because everybody has a different impression of like what they like or what they see as interesting. So yeah, keep going on management there. With the management
promotional look, I talk about Global Hunter, and I talk about, I know you're involved with the Canadian stocks. Like I've made money in the promotional CEOs, and I've not made money, right? And And I think in that sense, a promotional CEO is promotional for a reason, right? Because they have to, and there's nothing wrong. It's their job, right? And they think it's their job, right? And look, materials and minerals and gold, all those companies, they have to be promotionals, right? So it's different. They have to be.
And to be fair, at our event that we just had this week, we literally had one. It was like all tech names. But anyways, sorry.
Right, but a lot of them are, and there's nothing wrong with that. I've avoided it because
gotta do what they gotta do,
especially the crowded ones, right? The crowded ones, because if they're promotional, it's not a crowded trade. It probably means that there's not much there to begin with. But if they're promotional and super crowded, I just don't like crowded opportunities, right? And I've just tended to like Dave Waters is really good with this. I think if you had him on, he's really good and really good with finding these names.
Dave is. I've had him on multiple times here, and then also on the roundtable. And
he can talk more about it. Was this PIOE? That's actually my second largest holding, and it's kind of that similar grain. Like they, was it NOL shell to private equity behemoth is not really a narrative change. They were NOL shell, right? So it's not like they changed their business, right? That's what the business they took, but. It is in the sense that it fits the criteria. It did change, their business model from a nothing to a something. But they don't promote themselves, right? Like these guys, they have a business plan and they'll tell you everything you need to know, and they'll just execute, and then you see it, and then you can understand why people avoid it. But it's like they don't care, right? They're just like keep producing, and then for some reason nobody cares, right? No one talks about them, and they're okay with that. And I'm fascinated by these companies too, and like all these companies, there's quite a few of them that just don't have like having quarterly sales calls. They don't like even having an IR person. Everyone's got different opinions on IR persons. Like I think IR person is a good thing, right? They can help manage things, and ultimately it's a good thing for a company to have. If you want an IR person, you want to be able to tell your story. You want to have a deck, right? You want people to be able.
There's a big difference between like just promoting and like just telling your story. Like and I'm not being self-serving when I say this. We host events and all that kind of stuff. Like I do think it's really important for companies, even if they're much more conservative on doing conference calls or putting out a lot of press releases, you do owe it to the public markets and to your shareholders that you do need to tell the story.
You do. And that's a double-edged sword, right? You do. And, right. And I think, and then we talk about over promotion, but it is, I think people do have to realize that it's something that they have to do. Like people generally benefit from a higher stock price, right? And it is your job in essence to, ultimately you don't want to be self. So this is where I go back to John Malone. Like people will fight, but he doesn't care about stock price. He cares about his portfolio, and that's fine. It's just I do want a board and management that do care about shareholders in the sense where they think that's a priority. No, they don't need to be doing every podcast and going on the road every single other
doing
week.
Every conference,
right?
Like they don't right.
They don't need to do all of that, but to do it, a couple of times a year, like I know you have a conference and be on a conference every year. Like that's just something it's good for them. It checks the box, and at least they're trying, right? They're trying to fulfill that up. I mean, you want to be able to. When you do research on a company, you want to be able to immediately see a podcast and see a presentation from management, see a few people talk about it. It makes it easier, right? Like it just does. So
especially when you're talking microcaps, because some of these stories are very complicated, and it's a really good practice for you. Like when you're not just in your own bubble, it's like, how does nobody understand this? It's like, well, it's a very difficult story to understand because for the most part, you're not dealing with, you're not dealing with a supplement company or consumer good, you're dealing with the parts and the component of this or that, or, so it's good practice to get out there to tell the story so that you can get better at telling it, and to help, get more folks involved. Potentially.
Yeah, exactly. And just educate people, because ultimately I think, what I love about, and I joked about this the other day, is that microcap investors are, kind of just a different breed, right? It's just, they all are like, for some reason have weird similarities. It's amazing how similar microcap investors are.
We have that tick,
Yeah, it's like a tick. I don't know what it is. And I don't know, I shared my background, but it's not really clear why I enjoy it. I think it's that, the contrarianism, right? It's like, you know, and then the work, I think for me, it's the work you can do and what you can learn. And it's like an adventure. Like, it's like, you know, digging for gold, right? Like you can learn so much, and it's like nobody else is doing the work, right? And I mean, it's just cool. Like I talk about Acorn, and you know, they monitor generators, like industrial generators and home generators. So it's kind of cool. Like, talk to the Generac guy, like, what do you think about, you know, Omnimetrics, right? Their subsidiary. Like, what do you think about it? And it's kind of fun, right? And it's fun, and you know, share it. But yeah, you know, like when you share it to a friend, like, what is this? What do you think about Tesla? Like, I was like, what? Like, Tesla? I have no opinion on Tesla, right?
Yeah, no, like I was literally, I mean, I do this like literally every day. It's, you know, you start with the big idea. It's like, hey, what do you know about the, you know, this industry? I'm like, oh, well, let me tell you, this is how we do things. This is what we like. And then you're like, oh, that's interesting, because there's this one little microcap that's doing it a little different. Like, what do you think about that? You know, and they'd be like, oh, I don't know, like that could be interesting. And that's like, all right, well, maybe I might want to look into this a little more. Or you're like, oh okay, good. Like, how many stories? I mean, you use stories for days.
That's so fun. I love when, you know, you talk about, you do this and you run into someone that, like, well, like me sometimes, you're like, oh yeah, you hear about this, and I was like, okay, how much do they do in sales? They're like, it's so amazing. They have this technology, this patent, like these 20 patents, no one can beat it. And then it's like Shark Tank. It's like, well, how much do they do in sales? Like, well, they do $800,000. Like, okay, you know, it's grown 30%. I was like, okay, well, so you know, it's $800,000, and it's only 15 million market cap. It's like, well, they did $800,000 and they only sold 30%. Like, you know, it's like, you know, that's, I think, you know, I know we don't have too much time, but the thing with microcaps, people
let's keep wrapping. We're good.
Yeah, they're still small. Like, microcaps are small, right? They don't have the budget to do things. Like, they think about, you know, risk a lot more than a big company, right? That are engines, right? Like, you know, the microcap is kind of a, you know, they're definitely, they're kind of the odd person out a lot of times, right? They just don't have the budget for things. They, you know, when you have a low revenue base and cash flow base, like, you just can't do the same things, right? You'll just never get the flows, right? Unless that's your game, right? You want to grow and, you know, become an empire builder. But most microcaps aren't like that. And quite frankly, I found the most successful ones really are just slow and steady, right? That's why you got to give someone like David Waters, like, you know, credit to find these things and to do work on them and just sit on them, right? Like, I would love to be able to do something like that. Just, you know, you can just read and you know, I love my podcast with him because he just talks about like how he would, and this, I do this too sometimes with the OTC website, just put refresh, right? I thought that was the funniest thing in the world. It's like, how do you get your information? Well, I put refresh. You know, like, well, you're waiting for a press release and then come up. It's like, well, sometimes you have to go on the website. It's like, yeah, I've been there. I put refresh, right? Like PIOE, I remember when they were a pink sheet stock. They're not anymore. They did an IPO. But this was always frustrating. Like, they would put out a press release on the OTC website. Then you'd go on it and they'd say, oh, well, you actually have to go on our website to get the press release. Then you go on there and it takes you to their website. And then on their website, you got to go to another link, right? And then you go to another link and it sends you to the SEC website. It's like, I mean, you know, like, couldn't you just done this all in one press release? Like, and the press release is like 3 paragraphs, right? So, you know, like things like that. I'm always shocked, and I'm sure it has something to do with the filing requirements and how they do it, and then just no interest to make it right? Like these things, and it's just, you go in this micro cap land, it's an adventure, right? And then sharing it's such an adventure, right? Like, I like sharing stories, one for feedback, but two, to educate. So, and I've mentioned this on my podcast, like, growing your network is so important, right? Because you can't filter you can't screen these things. You can't, like in microcap land and special situations, you can't screen them. They're unscreenable, right? So it's like, you got to build what works for you. You know, the things that have worked for me, you know, you might have had bad situations. Like, somebody pitched me the other day HireQuest, which is like a franchise of you know, like basically like hiring, right? Cool, but you know, one of my biggest losses ever, permanent capital losses, was a company called Volt. Was the same. They did the same thing, right? They weren't a franchise company. They have franchises, but they essentially, you know, they hired and fired. They hired people. You know, it was third party hire. So that's what they did, and it did work. It was a disastrous investment for me, and I didn't understand the business enough. I didn't do the work, and you know, but that's an experience. Nothing against, you know, these type of companies, but it did not work, and I won't look at it again. So, you know, It's just something people pitch me and it sounds great, but it's like, that's not for me. So I tell people, just be comfortable, right? There's always something. You just got to look, and,
Right.
You got to look, and then, be skeptical, but, you'd be surprised. Like, when Maj talks about this, information arbitrage, like, I see it, right? Like, I see it. And it's not just in microcaps. You see it in the small caps too. Like, I've been fascinated, like, with DFIN, I think I found that arbitrage, and it's not there. And it's like people aren't reading the same things. It's like, it's there and people don't care because the information is not something you could screen for, but a screen can't just automatically translate that into, because a lot of times companies, they'll put stuff in their docs, right? That they have to. I mean, they'll say it and they have to, right? And it's funny in the queues, right? Because you can usually get some good and interesting tidbits in the queues that they'll just put something. It's like, why did you put that in your press release? Like I own an energy company, and they had a press release. They have a partnership with Apache, and Apache on their conference call, Apache's a $2 billion company. They highlighted, these 9 wells in the Permian Basin and how much success and how much they were flowing, like information that's, they made it important enough to highlight, and they have a 52% working interest. The company I own has a 48% interest. In a press release, no mention of it. And then in the queue, it says, we did these drills. They didn't give nearly as much detail, and they said, that it'll be incredibly incremental to our fourth quarter cash flow. It's like, why don't you say that in press release, right? And they have their reasons for that. I mean, I think they're a buyback. They buy back stock and they do things, and but it's like, something like that. Like, why does nobody care about that? It would be, whereas if Apache did something similar, thing would shoot up, right? And there's a lot of these things, but you do have to be looking for them, right? And then you have to, have a network. Sometimes, like, I didn't find that, someone else gave it to me, but you have to have a network. So I think what I do, what you do, all these podcasts, I was building a network. Like, everyone gets along with certain people over other people, right? And but having a network, that's where you can't screen, you can't have every idea. You can't. There's too many out there. How many of it? 10,000 companies out there? I mean, so I did the math on DFIN. There's like 5,000 publicly traded companies, but that's non-OTC, right? And then you have the OTC land. It's just like a ton of companies, right? And I will look at anything. I don't own many OTC companies anymore, but I don't know how much you've talked about this new rule, but it's I don't love it, but I'll never say no to OTC company, because there can always be something, right? And I don't know, that's what's fun about investing, man. You talk to people, and that's where you find the ideas, right? Like, you can't just own the same stock forever, because ideas change, right? Yeah, they change. Like, people talk about holding forever. You can't do that. That's the ideal thing, right? But a lot of times companies change and investment change. So you always got to be doing the work, and doing the work and looking can sometimes lead you down a path, right, to find something totally new, right? And when I did research on Acorn, I do regret, how should I phrase this? I learned a lot about Generac, right? And, in hindsight, I probably should have bought both. And, I couldn't have predicted the flows that went into Generac, right? Like, I knew at the time, this was 4 or 5 years ago, Generac was like $50. It was kind of that cyclical, it was a cyclical value stock. It would go to 20 times earnings, 10 times earnings, just like that, depending on the time of the year, storms. That's how it was traded. That's how it traded. They bought a couple software companies and started talking about green energy and solar and yada, yada, and combining it all with their battery. And then the stock and then you had, more storms than we had COVID, and the thing, it just went from $50 to $400 like that, right? On huge sales growth. And in my research, I was very positive on the growth and backup power generation, but I was like, man, these guys are sharks. Like, this company is like this company is going to be successful. I just said it's too big, right? What do I know? If I would have put money on Generac, I would have done better.
Absolutely, man. You've given so many good nuggets and answered all my what I usually ask everybody when we close it out. But, because look, yeah, we do got to kind of wrap up, because I feel like this could literally go on for another couple hours. So, I I'm not even going to ask you about Twitter takes because this has been way too interesting just talking about investing. So the next time you're on,
and on the Twitter takes, we'll
BS on that.
On the Twitter takes, I did want to say, I'll make some takes on food and things. I like to stick with food. Look,
it's real, right? You're not doing
I do believe all my food takes. And
okay,
I'll joke.
That was the main thing I wanted to get today.
I do believe all my food takes, but I joke on Rich's Niches Pod, my Twitter handle. I do joke that I have various conviction on these takes, right? I mean, look, people will engage in different ways. I like food because you're not gonna hurt anyone with a food take, right? It's people know, and they're ridiculous. Like it's not like I'm saying real, I always find it comical when people are like, "Oh, finally a good food take," and I'm like, I'll joke to myself, "Well, how about my other takes?" But it's comical. It's a way to engage. I do believe them all, but I actually do have a good food palate, right? I do believe I eat well, but I also eat garbage. So,
well, I have to ask. I mean, on this front, so I guess we will go there for a little bit. Here is what was the most either controversial or one that got the most engagement. And that you're like, wow, okay.
There's a few. The few have been, look, the problem with engagement is like people don't understand. It's like if you don't want me to make food takes, don't engage, right? But it's like you engage with them and you just want to be more outlandish. That's the thing with when you have a lot of followers, and I've noticed with big followers, like they just have to be more outlandish. It's the only way, right? So I've noticed the more outlandish I can be, the bigger takes of what everyone knows that. So, a recent one was actually good was the cup of noodles over, I'd said cup of noodles better than all Italian food, right? Italian pasta, usually trolling some people, right? That like are passionate about it. And the other one was, I think the other one was tuna, the tuna fish one, where I said canned tuna was better than, I forget what I said. That really got enraged people because I think I got a couple people that actually agreed, and people couldn't handle that. I think it's like there are people that really can't eat anything, so like canned tuna fish was something they would eat, right? Yeah. And it might have been canned tuna, I forget what it was, but that one was a big one. And I usually target somebody and we'll just make an outlandish food take, right? That's like, how do you come up with these ideas? Like, well, usually, someone will say something that's very serious, and I'll go the other way.
You know what? I got to say, this one really hurt me. And I think it inspired me this morning when you said sushi is overrated. That one hurt as an LA local with like, it's my wife and I's favorite. Like, oh, that one hurt my gut. It hurt.
I'll be honest with you. Somebody, I'll be, people aren't going to listen at this point, but it's,
they might.
They've been waiting. DM me about sushi, and sometimes you get inspired. Like, oh, sushi. I forgot about it. So I was like, sushi. People love sushi. I was like, let me just rip on it. And look, I even said when I say something is overrated, it clearly means that I like it, right? I do like sushi. But I live in a suburb. I tell people I live in a suburb of Manhattan. So suburbs are just, and at least we're in Manhattan, it's not Manhattan, right? So, you get sushi places that are sold to like, suburbia, right? And it's not going to be going to Manhattan, and having real sushi. But that one was a good one too, actually. People got fired up about that one. And that one was funny. I had no thought. Like, they take no thought.
I will change your mind. When you come to LA, I'm going to take you to our sushi place.
I love LA. It's great. I'm sure it's good. I'm sure it'll be great. But I would be like, this is probably way too expensive for what you're getting. I'd rather have a steak and some wine. Right? Sushi is only a pair.
I'll make you a better steak. I'll make you a better steak at home than you could get at a steakhouse. Okay.
Yeah, no, look, I know those are so fun. I mean, I appreciate. I like when people engage with them. They're funny. It's amazing how sensitive people get.
How do I get a Sosa shout out on a food take? What do I have to do?
You have to talk about food.
I know. I've been waiting.
That's the problem.
I know. I've been weighing it back and forth.
The thing is, I only do it when people I know that they're passionate about something, and I have to like them, right? I always say like I only troll someone if I like them, right? You gotta know you can handle it, right? They know I'm joking, right? Like I do believe my food takes. I definitely believe some way more than others, and it's just hilarious. You gotta be more outlandish. So it's hard, but it takes a lot of thought sometimes.
What's like a sensitive food take for you? Because now I gotta get percolating so I can.
It's the things that people like. When you like really like pizza. Oh my gosh, Let's all forget about the takes. I mean, the pizza. And I'm amazed how sensitive people get about things like pizza. Like, it's pizza. Like, I like pizza. You know, I don't love pizza, but it's pizza. And first of all, you can't say that. It's just pizza. Like, people go crazy. And then pineapple pizza. Like, people really dislike pineapple pizza. Like, I'll say this here again. I mean, I like pineapple pizza. I don't love it. I'll eat it. Right? If you give it to me, I'll eat it. But I don't.
Well, if it's like a half pineapple with, you know, whatever, and like half.
I like the pineapple with spice.
I'll try. You'll try it one slice, like, to get a little variety. But like, I'm not gonna order a pineapple pizza.
You go to it, and then then Domino's. I say Domino's the best pizza in the world. People can't handle that. It's like, come on, how do you think I believe that? You know, but I do like Domino's. Right?
See, this is why I love that you put out the takes, because like, I've actually had conversations with other investors where like we both follow you and we're like, what the hell is he fucking saying with this? Pardon my French. I'm sorry, everybody.
No, I don't know.
What does he say?
I think I've said this before. I said, like, you know, I have various conviction levels of my takes, and the pizza one, you know.
You should give a rating of your conviction level then. Like, you should do like, you know, the take and be like, all right, this is like a 3 out of 4 or 3 out of 5.
True, but then they'll get the outrage, and people get so. And then there's some people that are outraged, will fight back for fun, right? That they think it's so, you know. And then the other people take it serious, and they'll get the block, right, or the mute. You know, it's fun to talk about food. It's easy, right? And you know, it's not. You know, other people try to engage through more sensitive topics. You have to really, it's a fine line, right? You know, you don't want to, I think for me, and maybe this is naive of me, you know, food is not a sensitive topic, right? Like, you eat to live, and it's subjective. It's like, you know, people have, it's their taste from childhood, right? I know some people that eat like children, right? Like, they won't eat anything nice. Like, there's people like that. And it's like, well, that's the way they are. Like, well, you know, who cares? They don't care. A food take wouldn't bother them, because they'd be like, all right, whatever. Like, I don't care. It's food, right? I'll eat when I'm hungry, you know. But it's fun, and you know, it's been fun meeting people, and you know, it's good to share, right? And that's why, like I said, started a podcast. You know, it's good to meet other people and talk ideas and get to know one another, because that's what it's all about, right? That's 100%. Where you can learn, and there's so much to learn. There's so much that's changing all the time. So I appreciate you having me on.
No, absolutely, Richard. It's been an absolute pleasure. It was so good to have you on and really meet you. I have a feeling this is the first of many conversations we'll be having, either on here or on the roundtable for sure. So with that, where can our audience go and follow you, find more information on the Sosaverse?
Well, just on my Riches Niches Pod Twitter handle is Riches Niches Pod, and you know, you can just Google my name and you can find all my information, my business. But you know, for the most part, everyone knows where they can reach me, and it was nice to know you. And yes, I'm sure we'll talk more.
Absolutely. Thank you, Richard. Really appreciate it.
Thank you.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.